This week, our mortgage forbearances creating another housing bubble.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Welcome back. Mortgage forbearances are being extended, perhaps you've heard, but just how will home values and the borrower be impacted once that ends? It is a compassionate and pragmatic move, but the mortgage forbearance allows the borrower to suspend or reduce their monthly payments, but those back payments must be repaid, and that's one thing that many homeowners are forgetting. They think they have a payment holiday permanently. But there is good news. Borrowers that have a federally or GSE-backed mortgage, that would be FHA, VA, USDA, Fannie and Freddie, they're protected from the lender initiating a foreclosure action until December 31st of this year, thanks to the CARES Act. FHA-insured home equity conversion mortgage borrowers are certainly protected under that provision, but there is a less publicized portion of the Coronavirus Aid, Relief, and Economic Safety Act, or CARES Act, and it's one that is certain to have a major impact on the housing market and home values in the future. And that provision is the right for the aforementioned homeowners to apply for up to 6 months, and if desired, an extension for another 6 months, up to 360 days with no or partial payments as part of a forbearance. There's no documentation of financial hardship required to qualify. Basically, that means that there are going to be millions of American homeowners who will not be making a payment for up to 1 year. In essence, our government has attempted to stem a wave of foreclosures and also slow the damage to our fragile economy by delaying the inevitable. Now, there is a silver lining, and that is that home values should actually remain somewhat stable during this temporary calm, perhaps through the end of 2021. And that's a win for you as a reverse mortgage originator because you can offer the borrower more loan proceeds with a higher home value and, of course, low interest rates. Home sales, now those slowed to a crawl this spring as the first waves of COVID-19 hit our shores. And then the summer months, well, they brought us record home-breaking sales because we had a flood of pent-up volume and demand that hit the market all at once. But what's going to happen after all these mortgage forbearances work their way through the system? Now, there's many opinions, and some housing analysts are actually predicting that 1.9 million, or 40% of those who are in forbearance, are going to end up defaulting. Now, that's a sobering number, but it's nowhere close to the 3.1 million foreclosure filings that we saw in the 2008 housing crisis, and that created a glut of housing inventory, which drove prices down. Now, a correction in housing values is assured at some point in the future because the real estate market is cyclical, but it's unlikely that we're going to see the values plunge immediately. The hope is that the air will be released slowly from the housing bubble that we find ourselves in today. However, eventually there is going to be a toll that's extracted from the housing market for the unprecedented shutdown of our national economy due to the coronavirus pandemic. Now, housing prices are marching to the beat of a different drum today, and seniors are actually part of that new rhythm, which is further constraining housing inventory. Seniors are scaling down at a far slower rate than in previous years, constraining supply. We were predicting that baby boomers, like past generations at their age, would move into apartments, condos, or to their second homes en masse, said Ed Pinto. He's the director of the American Enterprise Institute, this in a recent Fortune magazine column, adding that is not occurring. A main reason is that they're not moving is that their adult children are moving back in and working from the home that they grew up in. Now, to conclude, there are two things that will mitigate the deflation of home values: housing demand and employment. And as more Americans regain employment, they're more likely to voluntarily decline further mortgage forbearance and resume making their regular payments. And all things considered, a gradual deflation in the housing market is preferable to a sudden bursting of the bubble. So what are your thoughts? You can be part of the conversation by leaving your comments in the comment section below, and you can become part of the Heckam World family, on YouTube that is, by clicking on the subscribe button. Also, don't forget that today and every Monday, you can listen to the latest episode of our weekly podcast, Heckam World Weekly, here at HeckhamWorld.com, iTunes, or on Podbean. Enjoy your week, keep the faith, and seize the opportunity that our current housing market does present.